Good morning, good morning, good morning. All right, my friends, Monday morning, and we are jumping right into our dividend portfolio update. As you can see, we are at $1,346.85. Yes, this is our dividend portfolio where over the past week, you can see our return is up 0.33%, which is $4.38. Not too shabby, not too shabby. But when we jump it out to the past month, you can see that increases up to about 3.42%. The past quarter, we go up to 4.71%. In 1 year, all time, when we started our portfolio on February 1st with $100, you can see our return is currently 15.92%, a gain of $128.80. And of course, when you dive into it and you look, you can see our earned dividend is almost $20, not quite there yet. And majority of this right now is our market gain. So one thing I want to put to your attention is, the significance behind a company that might appear to be doing well or might not be doing well, and how it doesn't necessarily mean it's not a good opportunity to buy. It's not a good opportunity. Right now, someone might be looking at my portfolio and saying, that company, New Tech Business Services Corp or Realty Income Corp, those guys are always killing it. They're always at the top of the list. And I want in. I think if they're always killing it like this, every time we see an updated video, we see Newt at the top, we want in, they must be the best opportunity to buy right now. That isn't necessarily the case. I mean, if anything, you should be thinking it might be a time to sell. It might be overbought. If it's killing it, if it's on such a high run, that might mean it's just already at its peak. Whereas something towards the bottom of this list, like AT&T, JP Morgan, Verizon, one of those might be a better opportunity to buy right now. In fact, JP Morgan, Chase Bank, well, as you can see in this article, it says dirt cheap JP Morgan Chase is a dividend stock to buy on the dip. This came out 4 days ago. So when we look at our portfolio update and you see Newt at the top, followed by Pepsi, then Realty Income Corp, followed by Coca-Cola, and all four of them are currently over 15%, which is great. Followed by, then we have 3M, Johnson & Johnson, Procter & Gamble, and then Verizon Communications, JP Morgan Chase, and AT&T, which, as you guys would know if you are a regular, we are considering trading them out, swapping them out, and getting someone else in here. We're not sure who yet. Maybe an ETF, maybe another REIT. We got to do our homework, do our research, and make some decisions. For now, we're still keeping them in here. I just want to see how things, if they have any other exciting plans that they might throw at us over the coming weeks. But we're gonna roll with them a little bit longer. You can check out one of my previous videos if you're interested in learning more about AT&T and what the situation is there. But with respect to JP Morgan Chase, I want to jump into this article and share, just kind of review this article with you and give you some insight and touch on why an opportunity like this might not be a bad move for some of you out there if you're considering adding one of these companies to your portfolio. Because again, right now, if you are someone balling on a budget, you got no excuses. This is a $25 a week portfolio. We started with $100. When we got our stimulus check, we put $500 in here. Of course, we wanted to, use some of it towards bills and then, get a little dinner or something, or maybe you wanted to treat yourself to a pair of kicks, something, I don't know, whatever it might have been. That's fine, but you should have put some of it towards some sort of portfolio like this, where you're helping yourself with saving for the future, with saving towards something. Because ultimately, and by saving, I mean just not spending your money. In this case, we're investing, but we're essentially saving our money. Too often, too frequently, people say they don't have enough money to invest. I was someone in that situation years ago, and I wish I came across something like this dividend portfolio where I'm just literally adding $25 a week. You don't notice it. You set it on basically autopilot. That's the beauty of this. We're just adding the $25 a week and we don't do anything else besides occasionally, you want to come in here and check on the companies you have in your portfolio and make sure things are going well. And when you see someone towards the bottom, like AT&T, we know the deal there. But JP Morgan, like I said, I wanted to do some research. Like, why are they at the bottom? Is this should we sell them? Is this the time to sell them? Get rid of them too? Let's dig around, look around, and see what we find. And I came across this article that speaks a little bit about J.P. Morgan Chase right now and their plans for the near future, and why. Again, I think if anything, you would want to consider adding them, not removing, adding more to your portfolio. So if you haven't started your dividend portfolio or any kind of portfolio yet, started really saving, gotten even beyond your emergency savings account of at least, that $1,000, $1,500, at least gotten that in place, you should absolutely consider clicking one of the links down below to either M1 Finance, which this is one of my favorite investing platforms, very easy to use, user-friendly, and you can start investing. And once you do, using my link down below, you will get, I think right now it's up to $50 for free. So you'll get not only the opportunity to start building your wealth, start truly getting yourself out of the tight crunch that you might be in, but also free money with it to help you speed that process up. Not much, but everything helps. Every time we add $25 in here, it's another step that's allowing us to move forward, move up. And that's what it's all about. It's a grind, it's a process, it's a journey, but the point is, literally it's trying to get from point A to point B or point Z, wherever your final destination may be. Yeah, I just think too often people don't think they can do it. And it's so easy to start investing. Click the links down below. Got a link to Webull as well, where you can get some free stocks when you start and fund your account as well. And also, I think BlockFi, Coinbase might be down there in the mix, since I do now have money, a little money, not much, but a little money with both of them. I might start making some content sharing my thoughts and, kind of just what I'm doing in those areas as well. But yeah, definitely, if you haven't yet, like this video and hit that subscribe button, hit that notification bell so you guys can stay up to date on our latest videos. And most importantly, you guys will be in a loop when we do start to roll out some more new video content more frequently. I've been slacking, but we're getting things positioned to be able to get the ball rolling, where the momentum will carry itself moving forward. And just getting a good plan, getting a good layout down so that things will, again, kind of get that snowball effect, which is exactly what you want to do with your investments, with your dividend portfolio. Because by getting this money in here, and when we get these earned dividends or any money from, obviously the market gain is staying there, but any earned dividends, we just have it go directly back into our portfolio. So along with our weekly contributions of $25, we also have our earned dividends just continue to go right back in here. We have it on auto invest. That is the beauty of this, and that is what it's all about. Now, when we jump over here and look at this article, and I'll have a link to this article down below, you can jump into the whole thing if you want to read. But America's biggest bank opened July 14th at $149.71 per share. That's a market cap of $447 billion, which sounds massive, but it's also a price to earnings ratio of just 10. There's also a dividend that yields 2.45%, better than a 30-year government bond. So this is, obviously it's not as high as others, but we have a reliable, strong company to work with here. And, especially if you're a customer of Chase Bank, which I am, it only makes sense that you would invest in them. Not always the case, but, usually you put your money with a company that, you spend your money with a good company, right? With a good product, with a good service. In the second quarter, JP Morgan earned $11.9 billion or $3.78 per share on net revenue of $31.4 billion. Return on common equity was a whopping 18%. The bank bought back $5.9 billion of stock and paid out $2.7 billion in dividends. Now, despite shares falling 2.5% directly following earnings, they've continued to fall since. The bears, blah, blah, blah. At tip range, JP Morgan stock is only a moderate buy, with 7 of 12 analysts feeling bullish, and a price target just 14% ahead of where the stock trades now. This despite the stock having advanced 59% in the past year and the possibility of higher dividends ahead. You can feel fear for the future at the bank. Hedge funds are being warned to expect midday margin calls if their trades don't work. There's a fear of inflation and overbankers going back to the office or refusing to return to the office. Bears say JP Morgan stock could fall to $140. Chart watchers note that the stock hit a high in early June and has fallen below its 50-day moving average. The past earnings price action seems to justify that fear. So why do we believe in a company like JP Morgan? Reasons to believe in JP Morgan stock. The most bearish indicator of JP Morgan stock may be the bank's efforts to make everything seem okay. CEO Jamie Dimon says the consumer is raring to go. Incomes are up, home values are up, savings are up, confidence is up. That $3 billion in reserves that just came back was from consumer loans that didn't go bad. The bank itself seems ready for action. Allison Bear, who heads up digital operations, claims her group has an underdog mentality despite having 46 million online customers. Plus, the company just made Open Invest its third fintech acquisition of the year. Its platform for building dynamic portfolios that conform to environmental, social, and governance (ESG) standards. JP Morgan Chase has also bought 55i, which creates tax-efficient portfolios, and Nutmeg, a robo-advisor. JP Morgan has a moat in trading. Its acquisition strategy is focused on building another one and handling investments for wealthy clients by cutting costs and automating. It's a strategy that makes sense. Automation, baby. Robo-advisors. Like they're trying to, they might be, yeah. I mean, there's a number of robo-advisor investing platforms, and I'm liking this creating tax-efficient portfolio. Like, yeah, they got plans, my friends. They got plans. So the bottom line with JP Morgan Chase, I don't churn my portfolio. I buy stocks and hold them for a long term. But I do try to time my purchases. I like to buy good companies when their stocks are relatively low and sell when everyone is screaming to buy. I'm old-fashioned that way. That makes JP Morgan stock a strong buy right now. It's a defensive stock for a strong franchise at a cheap price. It's the kind of stock you can stick in your portfolio and ignore for years while you go on about your business. And this is what I'm talking about. This is the kind of company you want in your portfolio. Well, it depends where you are in your journey. Most often, people don't want to have to come in here and check so frequently. You want to be able to kind of set it and forget it. And I believe JP Morgan Chase, as they are suggesting, is a company that you can do that with. Despite where they are right now, yes, things will fluctuate. Things will go up. Things will go down. In the long run, in the long term, JP Morgan will be higher than where they are right now, is what I believe. And I'm sure many of you do as well. I am a customer, as I mentioned. Obviously, you want to have a diversified portfolio. Having them in, to kind of represent the financial sector, I think is a good move on our part. And, maybe not the best move. Maybe there's a better option. But hey, I'm satisfied with them. Like I said, I'm a customer. I like them as a business, and I'm going to continue to rock with them. So on that note, let me know what you guys think about our current dividend portfolio, specifically JP Morgan Chase. Do you have them in your portfolio? And also, who should we swap out for AT&T? Should we get an ETF in here, keep them in there, continue to roll with it? We're almost at that 1350 mark, baby. So close. Oh, so close. But we're currently at, again, almost 16% return, which is great. Loving where we're at. And hopefully you guys have been motivated to start your dividend portfolio or some sort of portfolio investing somehow, some way, because, hey, that savings account is not going to cut it. You won't see returns like this. And furthermore, inflation is killing it, right? With inflation, that savings account doesn't get the job done. So get that ball rolling with your dividend portfolio, or just your portfolio. Again, it doesn't have to be a dividend portfolio. This is not my only portfolio, but this is the only public portfolio, of course. So on that note, let me know what you guys think. Comment down below, like this video, subscribe to the channel. You already know we got to keep it moving over here. But we'll see you in the next video. Peace.